Guy, undoubtedly, and particularly in the bear market territory we currently find ourselves, is there a new long-term attitude to risk, or is this something we can relate to the downturn?
I'm well known for having rather controversial views on risk. I think the fundamental problem we have about risk is that we have misunderstood what it is. Ever since Markowitz in the early 1950s, there's been this idea that risk is somehow the same as pure uncertainty of outcome, that you can look at it as an entity in itself, divorced from anything else, that you can look at it as it were objectively. And I don't believe any of that is true. I think risk only has any meaning at all if you apply it to an individual investor. And any investor, when they're starting on the investment strategy process, should sit down and ask themselves, what is it we are trying to achieve? Before they get on to all this stuff about what sort of investor are we, what are our resources, what are our limitations, what are we trying to achieve? Because the only true risk is that you don't achieve that target, which is your own individual subjective target.
Well, we've certainly seen investors back away from riskier asset classes. What do you think this means for emerging markets?
If you mean risk as volatility, which has very much been the traditional view, you could argue that volatility is not necessarily a bad thing. If you are a long-term investor, which most investors should be, then volatility gives you an opportunity to buy at a lower bottom and sell at a higher top. The problem is that many investors, and many of them are forced into this by corporate governance or investor expectation, many investors are forced into a short-term view. And if you are a short-term investor, you absolutely do not want volatility within your portfolio. And emerging markets have traditionally, historically, there's no necessarily any reason why this should persist in the future, but certainly in the past, emerging markets have in general been more volatile than developed markets.
Well, finally, how would you say risk-targeted funds have held up since the FTSE sell-off?
I have to say, in fairness, hedge funds get a lot of bad press, but one of the things that hedge funds have focused on over the last 10 to 15 years, they're viewed as very high-risk investments. For the most part, that's not fair. What hedge funds have been doing a lot of the time is seeking to reduce risk without at the same time reducing return. And a lot of those funds, certainly historically, held up reasonably well in difficult market conditions. The problem comes, again, emotion enters into this rather than logic, because as soon as you enter difficult territory, there is this urge to sell everything and buy the same thing that everybody else is buying. And that is where hedge funds have lost out in the past, arguably through investor behavior rather than necessarily market dynamics.